Hello, everybody. Welcome back to 21st Century Renaissance and another breakdown of the open interest newsletter for today's trading day, December 12th. I'm your host, Dr. Michael LoPiano. Very good to see you all again. Welcome back. Great news, not only in our earnings, but also in the earnings, I should say, in the price actions response to earnings. I know a lot of people quite pleased with the over $2 move we got yesterday in our price action. Certainly good to see in terms of appreciation of the underlying. What should we expect going forward, however? That's one of the major questions I'll be thinking about today. We're going to take a look at our technicals. We're going to take a look at our options data, see what we can see. We're also going to spend some time today taking a look at our particular implied volatility situation. So many of you will know who take a look at my article, take a look at my analytics. One of the areas that I spend some time on is IV on a regular basis. Looking at implied volatility, especially as we are trying to understand the impact that the options market has on our price action on a day-to-day basis, is incredibly important. IV can, does for many traders influence how they end up betting in the options market. It does tend to have an effect on how our options contract flows. It can tell us maybe things about upcoming corrections, things like this. In particular, we just went through an earnings event. There are always profound changes to our IV situation around earnings. So we're going to take some time looking at that. So let's get right into it. For those of you who perhaps have not taken a look at my analytics on a daily basis, you can always find my daily article on X. It is linked down in the video description. If you're watching this, of course, on X, then take a look just up top. It's pinned right at the top of the page. Okay, so let's hop into this. Today's article title, Bears Get IV Smacked. Yes, perhaps some other people get IV smacked as well. So this concept of IV crush, some of you maybe have heard this before, don't necessarily know what this refers to. This in particular pertains to events where there are profound changes in implied volatility, typically to the downside. Earnings, in particular, is one of those times that features very strong IV depreciations overnight. This happens a lot. In fact, I have been tracking these types of patterns. You'll see these patterns across a lot of stocks, but I've been tracking these patterns for the past few months, about the past 6 months in particular, on GameStop. One of the things, for example, that Roaring Kitty posted in his huge meme sequence back in May was maybe it was actually, I think it was after his May meme sequence. It may have been a part of his June meme sequence, but it was this thumper from Dune Part 2, right? When Paul Atreides is going to go ride the worm, which is called a maker. I and a number of others from Superstonk thought, what is this? What is this going on here? Does this have something to do, right? There's this idea that with a number of the different memes that Roaring Kitty puts out, that there may be some element of this in the market that these memes hint towards. So I remember having a conversation with somebody. I don't even know if this person is still active in Superstonk. Maybe they've been permanently removed from Reddit like me. But I remember having a conversation like this back in, it must have been in earlier August, maybe. No, it was late July. It was a post that was somewhere around July 27th, I want to say. And this person saw in particular that in mean implied volatility data, there were these very quick little spikes. So, but didn't know what they potentially meant. So I went and I took this and I did some research. I went through the same site. I used Alpha Query, which uses 10-day mean implied volatility. Unlike brokerages do not show you 10-day mean implied volatility. And it turns out with this 10-day mean implied volatility frame, you can see, right? You can see these spikes, and all of them are about exactly 10 trading, right? Exactly 10 trading days in length. This sort of gradual appreciation over a 10-day period, and then boop, down. And so I went back through GameStop where I saw this pattern, or where this particular person sort of noticed this pattern, right? It led up the squeeze, or to the sneeze, I should say, back in 2021, just after, and then it disappeared in 2022, sort of in later 2022 and in 2023, and it didn't return until the end of 2023. And then this pattern resumed, this sort of 10-day up and down, and then flat, 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 10 days up, spike, and then 1 day down, right? About a 3-day down period, but most of it in 1 day. So, right, this is something that happens on stocks, a lot of different stocks, very, very commonly, and this is earnings-induced IV appreciation and IV crush. Okay, so we will talk a little bit more about that when we get into today's article and how that in particular affected our price action a bit yesterday. And also maybe this can give you an idea of what really is going on, or how important keeping track of this dynamic is if you're going to trade options, right? Not necessarily giving trading advice, but pointing out a key metric here that if you're going to trade this is something to keep your eye on. Okay, so yesterday, in particular, we did get this big uptick in our prices I mentioned in my introduction. We saw over a $2 open to close appreciation, or close to close, I should say, appreciation in the stock, right? A $2.04 move. We closed $28.97, up from $26.93 just before earnings. So very cool, right? What actually happened yesterday? So very early on, right, we got some shorting in the pre-market to try to keep the price pinned as low as possible before, right, we opened, and then wow, we shot right up into this area between our sort of these decent sized gamma positions, call gamma positions at $29, decently above $28 as well. But we kind of bounced back and forth quite a bit between $29 and $28.50. In this overlap zone, this zone of overlap between the top portion of our bearish regression channel and the bottom portion of our bullish regression channel. So we stuck there for about an hour and a half, an hour and 45 minutes after this initial pop up. During this time period, right, despite the fact that we moved up basically $2 versus the closing price before earnings, we got this very interesting Oklahoma-shaped IV dip pattern, right? Okay, so even on brokerage reported IV, we can see just how profound this was. This goes down below 110% aggregate, and from open, despite the fact we had this huge upward shot in the price when we opened. That's a very volatile move. On a normal day, that would send the IV significantly upward. That's not what happened. Right? With the uncertainty of earnings dissipated, IV values are not necessarily assessed. They're not adjusted until the market opens. It just fell off a ledge immediately by about 8 percentage points here. And then despite the fact that we moved up and traded in this higher zone, IV bled and then kind of flattened out around 109, 110%. It traded back up when we got this big bullish trade up that walked us maybe to about $30. What it looked to me, and what it seems, say, from our options data, it does seem that, we'll come back to this in a second, it does seem that a lot of this price action was from short call holders, or I should say people who are short calls, and traders who had long puts exiting these positions in very large numbers very quickly early in the day. And so my suspicion there is that pre-market shorting was an attempt to basically get that price as low as possible, such as to get as much equity out of those short put position, or those long put positions, and some of those short call positions as possible before they were, completely ground into nothing, steamrolled by upward price action. So that definitely buoyed our price up quite a bit into that $30 call wall position there. We saw a high on the day of $30.18. So Richard Newton, by the way, called that out yesterday in his video. Definitely go take a look. That was one of the ideas, one of the things he potentially floated, that if these put holders wanted to get out of their position, it would have a nice buoyant effect on the price of the underlying, and he was correct. So go take a look over at his this video yesterday. Highly recommend it. So okay, but does that mean certainly bears took a big hit? Anybody who entered into these long puts, right? For example, so anybody holding this 2450 put, I took a look at this in the article. I worked this into my analysis if you want some deeper detail there, but you can see here's the value of this put, this long put at 2450, expiring expiring this week, so it's 12/13 long put at 2450 strike price. This put was worth 60 cents, a little over 60 cents heading into the close yesterday. And immediately as we opened, the price of that put fell to 5 cents. And I think it closed the day at something like below that. Yeah, it fell to 4 cents with a high on the day of 6 cents. So that put took a big hit. I spoke about this earlier in the week. I said, look, these are really convicted bearish bets, or it's stronger than selling a short call because you're going against IV crush and you're going against time. If you want to go bearish and you're not super convicted in your bearishness, or you can even not really be bearish in the underlying. So like, for example, you could be selling $35 or $40 calls with an expiry of this week. And, you could still be like, oh yeah, I think GME is going to go to $40 in a month, but not in 3 days. Like, you can still be bullish on the stock up to that price, but you can be short IV and you can be short time, right? You can say, I don't think that's going to happen in 2 days. And, that's time and IV are working in your favor there, especially going into an earnings period. IV is working in your favor if you're short a call. If you're long a put, you've got IV crush and you've got time working against you in that case. So if it doesn't move as far as you need it to move in the time period that you need it to move, when you need it to move, like, that bet's done. So, I mean, I guess you could say, right, somebody might have put that on as a hedge to a long call position that was possibly equally risky. But, I don't like to hold long options through earnings periods, particularly because we get stuff like this, right? And you might say, oh, but okay, the title of your article, Michael, bears get IV smacked. What about bulls? That's a good question. If you're holding long calls out of the money, if you pick those up, like even at the end of the day yesterday when they had the best price, if you pick these up like midday, you paid something like these are, so here we're looking at $30 weekly calls. For some of you, I don't know if you can look at, I don't know if you know this, but if you go into the options chain, like if you use Thinkorswim, if you go into the options chain, you can copy the specific ticker code, the securities code that's allocated to the contract that you're looking at, and you can actually get a full chart with volume and all of your technical measurements and things like that. So yeah, so you can look at how high of a premium these were trading at, because this purple line right here, this purple line is the theoretical value. The theoretical value according to what I guess it's mostly based on a Black-Scholes model. That's kind of the standard model that's used for options pricing. Look at how much higher the actual traded value of these $30 calls for Friday were, even into the end of the day, versus the theoretical value of this contract in this purple line. I mean, these calls were trading for most of the day at a 200% premium over their theoretical value. So, I mean, if you're looking for trades too, like into this type of action, like if you see wild divergence between the actual trade price of a contract and its theoretical value, you might be able to find, an incongruous opportunity between theory and the applied value here. So, or the value actually on the market. So a good sign that this contract may be a candidate to take a big hit coming out of an earnings period. You can see that pretty clearly right there. So yeah, even if you picked up this contract late in the day for 90 cents or 85 cents, even though the next day the stock opened at an underlying rate, the underlying price opened at $1.50 above where the close was. $1.50, something like 6 or 7% like above the previous day's close. These contracts dipped to slightly below their theoretical value, right? Definitely way more in convergence with their theoretical value. But instantly, even though we didn't see a real crazy IV adjustment on, say, the Schwab indicator. I mean, we saw some, right? This little like Oklahoma formation here in the IV. Like it did dip, but not that much. But apparently with these, right, the value of these contracts was so inflated off of this IV in the near term, right? Because this doesn't tell you what the IV value is of every particular contract. These were trading at a very inflated price, and even with a $1.50 move in the underlying, just having that uncertainty removed from the trading environment caused these to lose overnight from their closing price, basically 50% of their value. Yeah. So if you bought these late in the day, you had this very narrow opportunity when the stock price basically went to around $30 for about 20 minutes. Like you had a narrow opportunity here to basically exit these for a 20 or a 30% profit at most if you were trading these out of the money 30s. So out of the money calls into earnings, out of the money puts into earnings, like you better hope on a huge move real fast, or that's just not going to work out for you, right? Not trade advice, not financial advice, but be aware of this dynamic, because look, market makers still sell contracts into this. I mean, this is something of a best kept secret, maybe, right? If we go down and take a look at our mean implied volatility, right? You can see this here, right? We just took a 45 percentage point nosedive in the mean implied volatility that's reported by Alpha Query, even though we moved up $1.50 overnight instantly on the open. Yeah. So keep that in mind, right? This is profound. This has a huge effect on out of the money contracts, even out of the money contracts that aren't even that much out of the money, right? Like our opening price, we were close to $28.50. We were trading between $28.50 and $29. $30 contract is only $1 out of the money, and its value got cut in half. So keep this in mind, right? If you're going to go trade options, you're going to do that. You get excited by earnings. This stuff will happen. This is how brokers make bank. This is why they run this game, because of little tricks like this that especially unsuspecting people or people who don't, they're like, oh yeah, price goes up, contract goes up, price goes down, contract goes down. Not necessarily. So definitely keep that in mind. That's my little spiel on this trend. And for another data point, right, that's yet another quarter in a row where we had this effect take place. We saw this, right, starting at the end of 2023, continued through our quarters in 2024. I wrote about this extensively, right? This is where I first put this stuff together back in early September. We saw this for the Q2 earnings report. We saw it again here. So keep this in mind. Yeah. So where does this leave us, though, price action wise, right? So we definitely saw more of a bullish day, even though some options got shellacked heading out of earnings. Right throughout the day, we did trade up to 30, and we did trade significantly out of this previous bearish regression channel. So if we move down to our 4-hour chart, right? So what I basically sketched here is something like what I think each particular party here is going for. Bears, I would say now they're definitely, they've definitely lost the advantage. Bulls are definitely back in a position of advantage in terms of asserting the predominance of their particular technical paradigm. If bears want to come back at this, say next week, something like that, if they want to sort of work with market makers to keep the price kind of pinned here under this $30 call wall, market makers are definitely going to want that. We have 20,000 open contracts at $30 for this week, so they are not going to want to have to deliver on those, most likely. That would mean that, let's see, what's the delta on the 30s right now? It's a good ballpark for how many shares the market makers have. Delta on the 30s right now is 33. So if we're just going through a simpler sort of delta hedging model, then they've got, right, so ideally at a delta of 20,000 contracts, they would have, what is that? 2 million shares they would have to deliver on if those 30s end up in the money. And in an ideal sort of delta situation, right now, they've only got 660,000. So with these about to come close to expiry, right? I'm not sure how many they're actually holding in terms of gamma hedging. I don't know if they do like 1-to-1, like they, one share, just like a 1/10 of a point of delta equals like a long share that they have to hedge. I don't actually know how many shares they hold with respect to the gamma value. It might be more. They might also be holding, say, right, but it can also go down. So I don't actually know how many shares they're probably holding there. But if we just stick to a more basic delta hedging model and like estimate how many shares GME's designated market maker right now is holding, with the thought that they would have to deliver on their share obligations at T+1 on Monday for this, they're only holding 660,000 shares to hedge that $30 call position. So assuming that they're short all those calls, but a little harder to figure that out. But they're not going to want to go buy. They're not going to want to go buy another 1,330,000 shares at these kind of prices. If the price gets pushed over 30, it's like, even if it gets pushed over 30, it doesn't make the delta go crazy. It'll probably push the delta up into like the 50s range. But if they're, suffice to say, I won't go into crazy depth there, but they won't want that, is my guess. They would have to buy a lot of shares to really fully fulfill their obligations, although they'll have some to call in from people that get assigned. So it's looking like in these two scenarios, the bullish scenario has definitely reasserted itself over our bearish scenario. If bears want to try to have another go in here in the next couple of days to kind of push us back into this channel, first off, their channel is going to have to be a lot shallower as I've redrawn it here. And they have to really sell the idea of this 204-hour moving average target. And now it's going to be higher, right? So now instead of it, like when I said they had a real chance before of like a target before earnings, like back when the channel was way steeper down here, when it tracked with the 24-hour moving average, right? Like 24, that's where we saw all these people coming in and buying these long puts at $24 or at $24.50 or 25, right? They are like, oh yeah, well, this formation here, when the channel is this sharp, looks like going into earnings, there's a pretty strong chance, okay, we're going to hit maybe we hit this moving average at around 25. We get this little test, this little bounce on top of, the $25 call gamma position. And then maybe, Ryan Cohen does a share offering and that pushes us through, and then in the the 24s then print or something like that because they move in the money. That I think is what a lot of those long put holders were betting on. That got diverted. They tried to kind of force the issue back here to hopefully move us right, and we saw in the after hours we did move down into the 25s. 25.68 I think was our low. Again, really just trying to sell this touch of the 204-hour moving average, and that just didn't materialize for them again. And now we've had 2 attempted breakouts of this bullish regression channel get foiled, get reversed as soon as we kind of start to move out of them, either by this reaction to Roaring Kitty's tweet and yesterday's sort of bears running for the exit, and yeah, just bullish reaction overall to the earnings report. So I think the more conservative move here for bulls is to build up maybe some firepower, maybe sell some calls or something, just try to gain some premium off trading in this area until this triangle here formed by $30 as that call wall resistance, and this lower bound here of our bullish regression channel sort of just it gets too tight, we got nowhere to go, and then we just kind of pop on up there and kind of move back into the middle of this this channel here. I think market makers would probably like us, if they can't get this bearish capitulation scenario where we kind of collide with the 204-hour moving average. I think perhaps they'll want us to try to move up in here to again, right, they're going to want to keep the 35s are going to become really popular, and the 40s are going to become really popular as heavily traded call strikes. So, I mean, I think there might be this other incentive to want to keep the $30 to want to keep this big $30 position out of the money. I forget exactly. There's some people I think on Superstonk who pointed this out. I've pointed some of this out in some of my earlier charts. Like I think some of my earlier articles back in like October before our bull run went off, and I talked about in particular how I drew our attention to Roaring Kitty's RSI chart. So I won't get into too much detail with these. Maybe I can bring this up on one of our Q&A sessions over the weekend, or on a weekend sort of deeper dive. But we were basically going back to August 2022. From what would you say, from around the time of the sneeze, this lead up to the 2021 upward volatility event, up until August of 2022, on our weekly chart, we were trading above the midline of our RSI. So, let me actually go on and head over there. I think it's probably worth checking out. So, all right, yeah, I got a little bullish candle right here. We like to see that. But let's zoom out here. Excuse all my noise here. See if I can clean this up for us. Take out some of these moving averages to clarify things. Well, we don't really need to. I can point out right here, yeah, when our big bullish uptrend beginning in August of 2020 started, you can see that GME claimed this position above, basically around RSI neutral on the weekly chart. So RSI's relative strength index. It can be used to detect when something is overbought or oversold, something along those lines. And we kind of traded around. We used around RSI 50 as a support, and then we traded up into heavily overbought territory. But we never really, even throughout the cool-off period here, this initial cool-off period from the sneeze up to August of 2022, I think that's what we're looking at right here, yeah. Right, we didn't go below, yeah, this is 2022, maybe it's even before that, right? Is this 2022? Yeah, 2022. I guess it would be August of 20 or sort of like Q4 of 2021. So, right, we remained trading atop this RSI neutral level. We didn't go below this. And we had this triangular formation building up that looked a lot like, it might be something that would go back to the upside. And then all of a sudden, we sort of trended back down. And then, very curiously, the bottom just kind of fell out at our move into 2022. And basically, we had no weekly close. We had a couple weekly closes, a little bit above 30. But then, yeah, going into August of 2022, that was the last time we saw a weekly close above 30. So there's been some speculation that perhaps there were some other types of derivatives, maybe like some swaps that were entered into around that time, and whoever may be tied up with with market maker interests is trying to keep the price below $30. Not, yes, obviously market makers want this, but there may be this other interest that, well, maybe market makers know that there's all these swaps out there that are coming due this December. There's supposedly a lot of notional swap value that's freeing up their expiring swaps this December. And that this may result in a lot of margin calls, and market makers who have an interest, they have their maximum profitability points well below $30. For example, we can take a look at our max pain data here. Yeah. Right? These max pain points are all well below $30. Market makers have an interest. They may not necessarily be colluding with whoever hold these swaps. I mean, maybe they are. I don't know, but I have no data on that type of thing, so I'm not going to speculate. But certainly they have a common interest, right? If you entered into swaps at $30 and you profit from those swaps if GameStop is below $30, but you're out a lot of money if it's above that, and it's coming due this month, you might get margin called next month, especially as we've seen like a lot hedge funds, banks, whatever, no, not necessarily banks, but a lot of institutions. Who is this? Bravos Research pointed this out the other day. The current institutional exposure to the stock market, to equities, is approaching 100%. 100% stock market exposure. So, I mean, this means these are very highly leveraged portfolios. It doesn't mean that every single position in their portfolio is stocks, but it means they're highly leveraged. And based on their total leverage, right, their exposure to the stock market is at 100% of the portfolio value, right? That doesn't account for that other leverage elsewhere. So if they get margin called, that's going to send GameStop up higher. That's going to really not make market makers happy with optimal price points down in the upper 20s, the mid to upper 20s. So yeah, I would not be surprised to see us this week still strive to close the week below $30, right? I mean, maybe today, right, we break through that call wall like we did just before Thanksgiving, but then sort of slip toward, during trading tomorrow, once there's some charm help kind of degrading the deltas on those options contracts out of the money, or even slightly in the money above 30, right? Maybe market makers will try to ride that so we get another close below 30 this week. So keeping that in mind, like, bulls could come, drop a lot of money, try to push us through that and hold there now, but they might just try to save up some firepower, wait until more conservative players who are waiting for the culmination of that kind of triangle formed by the lower boundary of our bullish regression channel and that $30 call wall position, right? That hard line at $30, they reach a point, and then maybe there's something of a break to the upside. So I'm staying wary. I'm staying cautious, but I would say that yesterday's price action and what we're seeing right now are sort of reclaiming of the bullish channel, this bullish regression channel, or movement into way more stable trading conditions, right? Our price now is well within the lower part of this high call gamma exposure concentration. So this suppresses volatility. This makes it more expensive to push the stock down through the options market. It requires more money to overcome resistant market maker hedging action, pushing the price upward as you try to move it down. So, right, as you spend money on the approach in one direction or another to a call gamma dominant position, market maker hedging is working against you. So if you're moving toward $30, market maker hedging is moving against you as you do that. As you move away from it, it helps you out a little bit as gamma values go back up. But then below you, you get that support and resistance. So that's why when we're trading in these call gamma dominant areas, our trading is a lot more stable. We don't have these types of dips unless somebody is going out like we saw after Thanksgiving and borrowing 1.5 million shares and just dumping them on the tape right when we hit these key call gamma positions. So yeah, so I would say most likely is we kind of trade in this $28 to $30 bracket. Maybe try to close somewhere in here. Maybe try to log a red week of a close at like $28, $28.50, which is closer, much closer to the lower bound of our bullish regression channel. But we have so much. There's so much gamma exposure at $30. There's so many open contracts that I can only anticipate based on what I have seen and what I know to prove beneficial as an axiom in my own functional model for my trading, that market makers will not want this. They will try through whatever means they particularly have to try to keep the price underneath this $30 mark for another week if they can. So that's my outlook there. Definitely positive, right? I'm definitely looking forward to seeing what comes down the pipe the next couple of weeks, whether we do indeed see some of this requel action take place, like potentially Roaring Kitty has hinted at. I am looking forward to seeing over the next few weeks, maybe into January, this bullish uptrend resume, and to see if it takes us by mid or the end of the month up into not just the $30 to $35 trading bracket, but something like 35 to 40. If this this speculative stuff regarding swaps is a part of the requel, then we might see something a lot more volatile, something a lot closer to like what we anticipated seeing back in 2021. But I won't speculate on that for now. I think this gives you a good overview of what I'm looking at. I hope indeed, if there is something that you take away from this, you will reflect on this particular IV dynamic heading into and out of earnings that I've pointed out. And let's see what happens over the next couple weeks. Let's see what happens today. Let's go GameStop. Yeah. So thank you everybody for watching and listening. Look forward to seeing you during tomorrow's breakdown. And tomorrow I am going to be holding at market close. I will be looking at doing another live stream. We had a pretty good one despite some of the technical issues, technical difficulties earlier this week. But a number of you particularly said you're interested in doing sort of a weekly market close live stream with maybe some Q&A and just kind of talking about the day's trading, what we might be looking at heading into the next week. So we'll look forward to an announcement later today regarding that. And thank you so much. Thank you all for supporting me. Thank you so much for commenting, for leaving your feedback down in the comments, for participating on X and on YouTube. We'll see you guys tomorrow. Take care.